Hello, everyone, and welcome to Module 7 of the Game Plan Financial Simulation. John Hastings here. And in today's module, we are going to be talking a little bit about trading. Okay, so if you're going to go out and buy and sell, securities or exchange traded funds or something like that, some thoughts, ideas on what you should do in terms of trading, and then if trading is something that you just have no interest in doing, you typically go out and buy but you want to still invest your money, you go out and buy a fund, a mutual fund or a exchange traded fund. So what I'm doing in this latter part of this module is talking a little bit about exchange traded funds and mutual funds and kind of what they are, how they work kind of situation. Okay, so we kind of go back to, I believe it's module 3, where, we've done some planning. We figured out, okay, what's our asset allocation going to be based on our risk tolerance, our need for the cash or liquidity, our return requirements, our objectives, and we're going to come up with some sort of profile. Okay, so we're going to be conservative, balanced growth, or aggressive growth, or very conservative, whatever it may be. And as you can see in this detailed asset allocation chart, which is more or less just a template, so please take that with, take that as a bit of a precursor here. This is just sort of a template. Some people over time these things change, but more or less this is just kind of a model. This is what we're following sort of at RBC, and every once in a while we may increase allocation to one of these asset classes depending on the various situations that we're facing, so tactical or so forth. Okay, so just take that in, or keep that in mind, please. Anyways, so you come up with this asset allocation. You say, okay, well, now that I know how I want to allocate my money, let's figure out, where I should do it. Okay, and so this is sort of, at the asset class level. And then once you kind of go into each of these asset classes, you're thinking, okay, well, I'm going to own individual securities, or I'm going to go own a fund, or I'm going to own ETF to get coverage of that security, right? So if I'm going to own Canadian equities and so forth, and you got to figure out, okay, well, which companies I'm going to own. So, we talked a little bit about that with our equity and fixed income analysis, understanding what we want to, fill these buckets with effectively. And from there, you got to start thinking, okay, well, am I buying and holding? Am I going to be trading these securities, or what am I going to be doing? And so that's kind of what we want to talk about today. So, investment strategies, there's many, okay? And no one is right, no one is appropriate, no one is the best, no one is the worst, okay? It all depends on you, depends on your thoughts. So, when you have your initial allocation, so you get $10,000 and you're thinking, okay, how should I allocate these funds, right? Say, for instance, I'm just going to go and buy, I just want to invest in the stock market because I know I don't need this money for, 20 years or 30 years. So I'm just going to go and buy, some stocks, or I'm going to go and buy some equity or whatever it may be. And so you take that $10,000 and you say, okay, I have 10 stocks that I want to buy. And so you have the 1/n model. And so this is just saying, okay, I'm going to take that $10,000 bucks. I'm going to buy 10 stocks. So that's about $1,000 per stock that I'm going to invest. Okay. And so that will equate to however many shares, depending on the price of the share itself. Okay. The next step is, or another idea is what's called core satellite. Okay. So with the core satellite approach, you're basically saying, you know what, I'm going to take this $10,000 and about 50 to 75% I'm going to plug into a broad-based index. So this is going to be my core. Okay, so I'm going to use and buy an ETF, say, something that matches the global markets or the US market. I'm going to buy a US ETF or a Canadian ETF, whatever it may be, okay, or whatever the combination is. And that's going to be my core. And then I'm going to take the remainder of those funds and pick stocks that I have high conviction around. So for instance, maybe you're thinking, I know a lot in the tech space, so I'm going to go invest in a few companies in the tech space, right? So I'm going to take that 25%, I'm going to really focus in on the tech space, okay? And that's sort of the core satellite approach. And this is when I look at how I manage money for my clients, this is kind of the way I do it, where we'll have a core, and then we'll sort of have some high conviction on specific companies or asset classes that we feel we should overweight when we look at that initial asset allocation chart on the first two slides here. Then you have the day traders. Okay, so really, there may be some level of asset allocation that you're sort of following. but you're basically moving in and out of a trade on small moves ups or down and just sort of capturing gains when you can. I mean, this is not a bad strategy for some if you have the time and energy and you're sitting in front of your computer and this is how you want to make money. It's kind of like those folks that play poker every single day, right? They'll play, they'll make a few $100 hopefully, just playing some small games, but this is their job. They're day traders, they're professional poker players, whatever it is. This is how they make income, this is how they make money. And so, if you're an athlete, you're sitting around, you may be training a couple hours a day, early in the morning, in the afternoon, or whatever it is. You have all that time in the middle of the day to fill when you're not eating or sleeping or, doing something else. Day trading may be something that you'd be interested in doing. And I know a lot of athletes that do day trade. And especially with COVID, became even more prolific in the sense that there was just so many folks that are kind of taking to day trading, right? So that was, one of the big things. But with day trading, I mean, depending on the account in which you're trading in, so if it's a taxable account, and I'm going to do a, just for folks to know, I'm going to do a special, extra module here, talking a little bit about, accounts and TFSAs and RSPs and all that kind of stuff. So that will be module 9, which will be just a special one that I'll do for everyone. But anyways, if you're trading within a taxable account, well, it's very likely that you're going to be, if you're selling winners, you're going to be incurring gains, or you're going to be incurring capital gains, and you have to pay tax on those. In addition, regardless of where you're selling, I mean, some platforms allow for free trading now, but most others don't. So you're going to be paying that commission, that's $5 or $10 per trade commission on both the buy and sell. So it could add up over time. So just be mindful of that. And then you have some folks that just have no strategy at all. They just buy, sell on a whim. I mean, I've onboarded clients, so I've earned new clients where when we're looking at their portfolio, they have holdings that make no sense, that just they bought, because of someone told them, they gave them a tip, right? And they just bought, and there's no strategy at all. And so the idea is that we really want to kind of put a strategy into investing money. Okay, we want to have whatever it is, you want to have the strategy, you want to try to stick to it, because if you don't, you kind of deviate and go this way and that. I mean, one of those goals that we have with investing is to earn money, to build our wealth. And if we just don't have that capability, if we're sort of going around the gamut and trying different things, which is fine, I suppose, but you want to have a strategy when you're investing your money so that you can kind of build that wealth. And if you're not building that wealth, then you can kind of revisit your strategy and figure out if there's something better for you to do. Okay, so trading strategies, I mean, this is the whole buying and selling, and I mean, this is probably the biggest challenge for any investor, whether it's a do-it-yourself investor, whether it's a professional money manager. I mean, when to buy, when to sell, right? And so, I mean, for many of you playing the financial simulation game right now or taking part in it, I mean, what's a good price, right? You could look at historical prices where you're looking at the price relative to the 52-week highs and lows, and that's one way to do it. But that's more looking at, when we think about the efficient market hypothesis and some of the portfolio theory that's out there, we don't necessarily want to look at the past, we want to look at the future. And so, looking at where the price of the company is from, where it is relative to the past is okay, I suppose. But, it's sort of factoring in the fact that, that old price is reflected about, what happened in the past, not what's going to happen in the future. So that's one strategy. And, there's a number of people being like, oh, I hear this from my clients all the time where they're like, oh, I looked at a company and it's cheaper today than it was, 2 weeks ago or 3 weeks ago. Well, yeah, maybe that's the case, but why, right? What's happening? Is this a systemic or unsystemic change, right? Is this something that, just the market in general is just down, or did something happen at this company on the company level, which is making it cheaper or so forth, right? So you want to sort of dig into it and figure out what a good price is. But really, when we're doing our analysis, we have analysts that kind of look, and we call them sell-side analysts, and they say, okay, well, we're doing the research, and we've figured out that this company, if they achieve X, Y, and Z based on their strategy and based on what their plans are, we believe that the value of the company could be this, right? So it's looking at what we call the intrinsic value, and this is typically determined by a number of different metrics, sometimes called discounted cash flow modeling, or some sort of other metric, which we didn't talk about in the equity valuation standpoint, but because a bit outside the scope of this course or these classes, these modules. But the idea is that there's a future price, and you kind of say, well, today's trading at $10 based on the analyst's expectations, and those are the consensus analyst expectations. We think it could be trading at $20, and if that's the case, then well, yeah, okay, well maybe it's going to go up, right? Might not go to 20, but it certainly will go up. So go on and take in consideration that. Some other strategies to consider when you're buying and selling, especially for those who aren't going to be day traders, but still want to be taking part in buying and selling their own securities and doing their own work. You put in these limit orders or market orders. Okay, so market order is buying something at what the price is today, where a limit order is buying something at a price that you assign. So you could say, okay, well, this company is trading at $10. It seems quite steep. Been doing some analysis. If it goes down to $9 or $8, I'll buy it, right? But what happens if that movement happens really quickly and you miss it? So what you do is you put a limit order in. You say, okay, well, I'm going to put a limit order to buy this at $8. And if that hits, great. If it doesn't, okay, well, then the order expires, or you can keep it indefinitely. Okay. And that's for buying. And then on the selling side, you could say, okay, well, you know what, I don't want to take too much of a loss on this company, so I'm going to put a stop loss in or a stop limit order. Meaning, okay, well, if I buy this company and I want to protect the downside, so I don't want to lose that much, I'm going to say, okay, well, it's selling at 10. I don't feel comfortable I feel okay taking a 10% loss. So I'm going to, put a stop loss or stop limit order in at $9, which would effectively be a 10% drop from, 10, and everything will be sold, or a part of it would be sold at $10. Okay. So these are just sort of ways that you can kind of, control the price you're going to pay, and control the downside effectively. Right. And you can also control the upside too, because you can say, okay, well, I want to say at, I'm going to put an order in and say, okay, well, I'm going to buy it at 8, or I'm going to buy it at 9, and then I'm going to sell it at 12, right? And so you can put these sort of these limit orders in that would enable these sales and purchases to happen, right? But anyways, I mean, the biggest challenge really is, okay, well, what happens, and we saw this year, what's your strategy, right? Do you sell when something goes up 10% or goes down 10%? Do you sell a little bit? Do you sell a lot? I mean, there's no right way to do this, okay? And I've been doing this for some time now. The one strategy I do have to sort of say is that, when a stock doubles in price, and we saw this year, what I tend to do and what I sort of encourage others to do is to sort of take the principal out. So say if you invested $1,000, all of a sudden the stock is now trading and it's doubled in price, so it's now $2,000. Take that profit, take that initial principal out, so the $1,000, and then redeploy it somewhere else, right? And I mean, you don't have to do this if you don't have any better investment idea, but the idea is really simple. It's saying, okay, well, you know what? I've doubled my money. I'll let the company keep growing because I think it's a fantastic company, and I just kind of want to take my initial principal out and redeploy it somewhere else, right? So that's one idea. Other times people will take maybe half of it out, and sometimes people just leave it in there and let it run, right? Because they think it's going somewhere. But the thing is that you don't want to fall into one of those biases, or one of those sort of where something goes up 1,000 or doubles in price and then drops, right? You want to be able to kind of capture those gains, because when we're building wealth, it's not only earning more money from working and so forth, but it's also investing our money properly, where we're taking those gains, we're being systematic, we're being strategic with how we manage our money going forward, right? So that's sort of the idea or the notion there. I mean, the other big thing too, and this is where most people fail, is in rebalancing. So some people deploy what's called a buy and hold strategy, where you just buy and you never sell, right? Which can be fine. It's good for the passive investor, it's cheapest and so forth. But what ends up happening over time is, if you're in a specific risk profile, so if you're a balanced investor and you deploy this buy and hold, what may happen is that, without proper management, you may find yourself into a aggressive growth profile, or just a growth profile, because the stocks you own have appreciated in value. Or if you haven't sold, when something has just sort of fallen to the wayside, well, you may find yourself into conservative profile, right? So the idea is that you want to be making sure that you're sort of staying within your profile, because that's really, that's what helps, that's part of your plan, right? So when you do the planning up front, when you figure out, okay, what do I need? When do I need it? And what sort of risk am I willing to take? You kind of want to stick to that. Otherwise, you may find yourself in a position where you jeopardize, the ability to achieve a goal or not, right? There's a constant mix, which is, okay, if you're a balanced investor, the idea is you maintain that 60-40 split at all times. There's a number of times and areas when these various strategies will work better than the other. So buy and hold versus constant mix, or the constant portfolio proportion insurance, which I won't go into because it's a little bit more convoluted. And so, picking one over the other and kind of switching between each is, can be, it's like kind of the investment strategy where, like if you don't have a strategy, if you're not going to stick to a specific plan, it probably won't work, or it won't work to its full capacity. So, just stick one which you feel comfortable with and go with it, right? But I think the most important thing is always making sure you have that balance, right? So if you're reviewing your portfolio, if you're reviewing your plans on a monthly or a yearly basis at a minimum, you could do it monthly, you could do quarterly, or whatever you may be. But, as long as you're kind of looking at your plan and making sure your strategy or your investments and your portfolio is aligned with that plan, I think you're going to find yourself in good shape, okay? And that's sort of, the practice that you want to get yourself into. So with rebalancing, as I was sort of alluding to there, you can do it on a calendar basis, every month, quarter, year. That's kind of how I deploy things. But also there's a percentage of portfolio, okay? And so that's saying, okay, well, one asset class. So say, for instance, your bucket of equity, your target is 60%. All of a sudden, that 60% jumps up to, say, 75% because we've had a fantastic run in the market. Well, at that point, it triggers rebalancing. So you sell that 15% in equity, add it to the fixed income to kind of maintain that 60-40 balance, okay? So you sort of establish these specific corridors, which triggers a buy and sell of a particular asset class. And if you want to even get even more down to minutia, you could do it on a case by case or investment by investment stance, okay? So monitoring the portfolio is really important. The biggest thing here is, are you making or losing money? Okay, so benchmark, in sport, it's really simple. In certain sports, there's you got your Olympic standards, you have your, there's tests that, are relatively great because there's lots of data and information about it. So you can sort of see where you're at in terms of, how do I rank up versus my competitors, my peers, whatever it may be. At a race, you can kind of see if, your performance is going well based on, or your training is good based on your performance, right? There's always a benchmark. There's always that like instantaneous feedback. And so with investing, it's the same. There's always these benchmarks that you have to say, okay, well, if I'm managing my money, if I'm picking my stocks, how am I doing relative to a benchmark, right? And this is probably the hardest thing for some folks to sort of, subscribe to, because they don't want to admit that maybe they're not doing as well as a benchmark, right? And remember in the equity module, I was saying, as investors in some asset classes, some areas around the world, it's hard to beat the benchmark, right? So it's hard in the U.S. for you to beat the S&P 500, and if you do, you're in that top decile. You're in that top 10% of money managers, right? And it's not, on a year-over-year basis, or maybe in 1 year, maybe in 2020, you're going to come out on top and beat the S&P 500 because you picked those tech names that did so well, right? But next year, maybe you're still holding on to those tech names, thinking that they're going to continue. But unfortunately, tech came out of favor because of regulation, and there's a new asset class. There's a new pony in town. There's a new one that's winning, right? But you haven't jumped on that, so maybe you're failing the benchmark, right? So it's really important not to sort of delude yourself and present yourself making you feel really confident about what you're doing, right? You want to make sure that you're staying on top of this. You want to make sure that you're keeping yourself honest. And just like in sport, you're keeping honest by knowing, okay, well, yeah, I did really bad in this race, or I missed the team, or I did something. And, when you kind of recount why it happened, perhaps it's because, well, you kind of skipped an entire month of training, right? You were sort of slack and you weren't doing something, or maybe there was some other aspect that was happening that, you could correct or could fix, right? So it's one of these these are really important aspects with investing is keeping that benchmark, because you want to monitor and make sure you're doing as well as you should be, right? With planning, and if you do the appropriate planning, the benchmark, some situations you can compare the benchmark to the market and what's happening in the market. But if you've done the appropriate planning, you can say, okay, well, in order for me to achieve my goal in 5 years, I need to earn a rate of return of 5% or more on an annual basis, right? So that effectively becomes your benchmark, and that's what you're trying to compare to. And that's, in my opinion, that's the more important metric that you want to be looking at, and that's goals-based investing, right? Where you're saying, okay, I have a goal in mind. I need to achieve a specific rate of return, and if I do that, then I'm going to be able to achieve my goal. It's when we start looking at your actual investments versus, say, a benchmark, really what you're trying to determine is, am I taking too much risk to achieve this 5% a year? And that's kind of what you'd be able to discern from looking at sort of a market benchmark. Okay. But it's important that you're doing this analysis and you're sort of setting these benchmarks in beforehand. They're specified in advance, and that you're comparing apples to apples, right? So, if you have a Canadian portfolio or you have a portfolio that's just filled with Canadian stocks, well, it's not appropriate to compare your portfolio to, say, the S&P 500, right? Or compare your portfolio to, a basket of tech companies. It's completely different, right? They have different return attributes and so forth. So you just want to make sure it's appropriate, okay? So now that we've sort of covered some of the concepts around trading and how to actually manage your portfolio, if that's the approach you're going to do, and if you're thinking to yourself, oh my God, that's just way too much work, I don't want to do that. Well, let's start thinking about, okay, well, how else are you gonna invest your money, right? You remember, I think I've said before, where you have cash, right? You can keep your money in cash. You can invest in real estate. You can put it in the equity markets. You can put it in the fixed income markets, right? You got to do something with that money, because if it's just stuck in cash, it's just not going to be as productive, and you're not going to be able to achieve your goals as you wish. So, then we start thinking, okay, well, if you don't want to manage your money yourself, you go speak to someone like myself or another advisor or someone to kind of help you make those decisions, right? Or if you don't feel like you need an advisor and you kind of want to still do it yourself, but get some additional help, well, that's when you start looking at exchange traded funds or mutual funds. Okay, so mutual funds, I mean, they're the biggest. They're pool of funds collected from many investors for the purpose of actively investing. So essentially, think of it this way: you take your money, you give it to a company, an asset manager. We'll just say RBC Global Asset Management. You select a fund, right? And we go back to the equity class. You learned about small cap and large cap, and growth and value. So there's a whole basket of funds that are out there. There's some that are just balanced portfolios or growth portfolios, right? And it's all based on asset allocation. So how much is going to be, they kind of do all the hard work for you. All you have to do is figure out, okay, am I a growth profile investor, a balanced profile, or a conservative portfolio profile, or whatever it is, right? And you can just select the fund itself, right? And so what you're doing is you're handing your money over to a professional money manager, and they're investing your funds for you, okay? And it's as simple as that. So you give the money. In return, you get units of a fund, and the mutual fund will have both return aspects. So there'll be capital gains based on the underlying holdings within the fund. So think of it this way: you're handing your money, someone's a portfolio manager, so they're picking all the stocks or all the funds or whatever it may be for you, and you just sit back and you just collect, whatever capital gain comes out or distribution. So every single quarter, every single year, these funds will typically pay a distribution, which will be a combination of capital gains and dividend income or interest income, whatever it may be, and you'll receive a big bit of a check, right? Or you'll get more units purchased for you on your behalf, right? So with a fund or with an exchange traded fund, you typically, these portfolio exchange traded funds, let me rephrase that. With a fund, you don't have to really necessarily worry about rebalancing, right? So if you buy a generic balanced mutual fund, the fund itself is rebalancing. Now, if you buy a bunch of different funds, say you buy a Canadian equity fund, a US equity fund, and a bond fund, well, you're going to have to kind of go in there and do some rebalancing for yourself, just to make sure it continues to maintain alignment with your objectives. Or you can just sort of say, I just want the turnkey solution. I'm one and done, right? So it all depends on who you are and how much energy you want to invest in this. But I mean, the biggest thing is always looking at the funds because there's so many, and making sure you pick the appropriate ones that are right for you, that have good track records, that have good, portfolio managers and so forth. And, hopefully some of these modules will kind of give you some more perspective on what to look for. But more or less, you're looking for, how's this fund compared to its benchmark? How do these fund managers compare to other fund managers in the same class? Are they, what quartile are they in? The top quartile or in the bottom? How much am I paying, right? There's this thing called the management expense ratio, or MER. Some are high, some are low, and kind of just want to assess it that way, right? But more importantly, or what we're seeing more of a growing proliferation, is in exchange traded funds, or ETFs. So with an ETF, you're basically buying indices, okay? And we talked about this in the equity module, where you can buy, world index, you can buy a, geographic index, so you can buy an ETF that tracks the Canadian equity markets. You can buy an ETF that is a portfolio of ETFs, right? And these are kind of, I think, very, very popular right now. The difference between ETFs and, say, a mutual fund is just more or less the expenses, right? So they're quite a bit cheaper, mutual funds versus ETFs. So ETFs are the cheaper version. ETFs are often passively managed, so you're just buying an index. So you don't have any portfolio manager overseeing the companies that are in there. You're buying an index that just, is the top 60 companies in Toronto or in Canada, or the top 500 companies in the US, right? And you own a fraction of each of these by owning one unit of this ETF, okay? So, those are the kind of the products that are out there. I would suggest you do some more exploration into the space, but, it's if you don't want to go and pick and choose your own companies, or if you only want to, if you want to do the core satellite approach, you want to have a core solution that's a mutual fund or an ETF, they're there. And then you can go and, take to the other allocation that you're going to assign to individual companies that you have, some knowledge around, or some interest in, and invest that way. Okay. So there's a number of different reasons, but this is kind of how it typically works with a fund. Okay. So you're the investor, you give money to the investment fund or the asset management company. The asset management company invests in equity and debt securities on your behalf. They generate a return, hopefully, and then the investment fund returns that back to you. So there's just an intermediary in between there, right? So working with an advisor like myself, you'd be the investor, you'd be giving me money. I would effectively be selecting either securities, depending on who you are, what your needs are, all those different variables, and or helping you pick select funds or whatever it may be, and that's kind of how it works. Okay. So again, this is important. I think this slide and kind of gives you some perspective on what I was explaining there, where how do you pick the right mutual fund? How do you pick the right ETF? So you look at the experience of the management track record. So mostly for mutual funds, performance, return, Sharpe ratio, just Google that. The firm itself, so and how much money they have under management. Normally, the longer mutual funds are great. Often what happens in the industry is, if a fund is launched, but doesn't get traction, so there's not enough assets under management, so they may fold it up, or the fund company may fold it up, or merge it with another one. So you want to look at a fund that's been around for some time, or gaining a lot of assets really quickly, because it's it's tapping into a new sector, new area that has been sort of overlooked. You then want to be looking at the category, the sector, the geography. So again, large cap, small cap, equity, fixed income, Canada, US, global, whatever it may be. And then the style, so growth versus value, and making sure that you're lining your money up properly, right? But most of the time, people won't necessarily just buy one, Canadian equity or Canadian equity sort of mutual fund. They'll normally just buy a balanced mutual fund, or they'll buy a growth mutual fund or something like this that reflects their profile. So that's often the case with the do-it-yourselfers. Okay. Index funds, as I said, you're basically just buying an ETF index fund. You're basically just buying, the S&P 500. So by doing that, you're owning all the companies that are in the S&P 500. So I mean, it's a passive approach to investing. ETFs there's this huge proliferation of ETFs. There's so many of them. So it's almost becoming challenging to pick the right ones. But the big companies out there have a nice little lineup. So look there to see, right? Again, here's some information on ETFs. if you're the passive investor, if you're someone who's just, you know what, I want to invest my money, I don't care to look at this thing every day, or, maybe I just look at it on an annual basis. I want to be as frugal as possible because, I don't want to be paying a whole lot in fees. Then we'd be looking at ETFs. And one of the big thing with ETFs is this whole notion of the efficient market hypothesis. So certain markets are efficient, meaning that, all information is already priced into the index, to the companies that are in there. So there's no real way to kind of outperform the market, right? So you have to do some more digging and some more analysis to determine, okay, is this market efficient? And if it's efficient, then yeah, maybe you just buy an ETF, right? And so, lots of research out there just kind of explain which markets are efficient. Typically, fixed income is pretty efficient. The U.S. equity market, as I said, the large cap U.S. equity market, as I said, pretty efficient. Canada, there's some opportunity to take an active approach there. So this is where a mutual fund or some active management makes sense. So picking and choosing your own stocks, because it's possible to outperform and beat the market, right? And so that's kind of the main difference when we started looking at, okay, do I pick one or the other, right? Most people get kind of blinded by the fact that, yeah, it's ETF is much cheaper than a mutual fund, but if a fund has been outperforming the benchmark, which is effectively the index, and that's what you'd be buying if you'd be buying an ETF, then you got to start thinking about that, right? And so, is it worth paying for a mutual fund at that point in time? Probably, right? So if I got to pay 1% or 2% or whatever the fee is, but I'm making 10% versus if I was just buying the index or the ETF, which is a fraction of the cost, but I'm only making, say, 8% or 6%, then yeah, I'll take that. I'll pay the money to get a little bit more value out of it, right? So you kind of have to do some analysis on that level just to make sure that if you're picking a mutual fund, it's actually outperforming, right? And depending on the asset class, depending on where you're investing, will dictate whether an ETF is better than a mutual fund. Okay, so here's some further sort of discussion on it. ETFs again, just that very cost-conscious passive investor. Mutual funds, this is a manager, and you really want to make sure that they're outperforming before you select. Okay. Again, you use these products if you don't have time and just don't care about investing or don't want to learn, and you just sort of say, you know what, I have money, I need to invest it somehow. I'm just gonna hand it over to these ETFs or these mutual funds. Okay. So whatever your trading style, whatever it is you decide to do. So if you're going to go and pick and choose stocks and you're going to build your own portfolio, just pick a style, pick a strategy, and be disciplined with it. Okay, that's the biggest thing I can say. Rebalancing, just making sure you're not holding on to losers too long, or you're selling winners too early, or you're kind of staying disciplined. You have rules around how you're going to buy and sell. That's the biggest thing. And if you don't care to trade, if you don't care to do all that research that we've been talking about, well, this is where you're going to want to use a product. You want to use an investment vehicle, such as an ETF or a mutual fund, to kind of help you with your investments, right? Or seek the advice from an advisor to kind of help you and guide you along that way, so that you don't make mistakes, so you don't lose money, right? Because it's really easy to kind of jump on the bandwagon and buy something when it's at peak and have it go down, and then make those wrong decisions of selling that at the ultimate loss, or holding on to a losing stock for too long, right? So these are some of the considerations you want to be thinking about or exploring more as you begin to manage and trade and so forth within your portfolio. Anyways, that's it for Module 7. We'll talk soon. Thank you.